Welcome to Cash Talk, the podcast where we delve into the depths of finance, business, and life itself. I'm your host, John Cachia, a multi-award-winning wealth advisor with a passion for empowering ambitious Australians to confidently achieve financial freedom. Hey everyone, before we get started, this is a quick reminder that everything in this podcast is of a general nature and nothing has been tailored to your personal circumstances. So please seek personal financial advice before acting on this information. Welcome back to Cash Talk, and today I'm joined by Anthony. Anthony, how are you, mate?
Good, thanks yourself.
Yeah, not bad. It's been an interesting period. We've had finally a interest rate cut, and when I mean finally, a lot of people have been waiting for this one. Obviously, a lot of mortgage holders, and I want to dive in today around what that means for mortgage holders, what it means for investors, what it means to the economy, and things you need to kind of look out for when this actually hits the bank account. So first and foremost, RBA has dropped interest rates by about a quarter of a percent in light of data that they're starting to see, which is showing signs of the economy slowing down. Now, in itself, that's obviously something to be aware of, that when a central bank is saying that there's signs that the economy is slowing down, they don't usually say it in those words. They're more talking around that inflation's, subsiding. So we need to just be aware that the central bank, through monetary policy, is taking a really, really close eye to ensure that the increase in the cash rate over a period of time is not putting the economy in a position that it's not going to grow, that it doesn't go stagnant and doesn't fall away. So they've taken this 0.25%, obviously applied that. Lenders have come out in response to that, which I'll get to Anthony in a moment in regards to those, but as well too that the governor has also said that they're keeping a close eye on this, and it doesn't mean that they're now going to go into a rate cutting cycle. It was clear on that they want to monitor this last decision and see how that plays out in the economy. So, Anth, in regards to the lenders, what was their response in regards to cash rate dropping on the 18th of February 2025?
Yeah, so pretty much all the lenders have passed on that rate cut. Most of them are either coming into effect as of today or by about mid-March. Mm-hmm. So yes, there is a bit of a delay between the cut actually happening, getting announced, and then the lenders passing it on. There is a bit of work they need to do from their end in order to pass it on to everyone. But that should be starting to the mortgage holders should start to see that coming through today and in the next couple of weeks, which would be really nice.
And it was really good. Like we get obviously a lot of notifications in regards to the lenders cutting, and I think CBA, Westpac were like bang bang straight out. It was like they have pre-prepared communication. It came out that quickly.
CBA was literally like a couple minutes after it was already out. They were on the ball, like they knew it was going to happen.
Yeah, and obviously they've got a lot of the data as well too. So these major lenders are so invested in the debt market that they need to be mindful of what's going on, and they're a big stakeholder in the Australian economy as well. But and when lenders do drop interest rates, what actually happens? Because it's been, whatever it is, maybe I think it's been a few years since a rate cut's happened. I'm going to say at least maybe 4 years. It's been since COVID. What happens to your repayments? Like what actually?
Yeah. So look, all the lenders are a little bit different. Mm-hmm. You should get an email. Everyone should pretty much get an email from the lender saying this is your new rate and when it will take effect. And then the difference between your current repayments and the new repayments. Mm-hmm. Some lenders will automatically decrease to your minimum repayments, where others might just say, hey, look, this is your new minimum repayment. Mm-hmm. If you want to change that, you can go off and change that yourself. So most banks won't actually just decrease your repayment to the minimum. It's something that you might need to jump on your internet banking, online banking, and just adjust yourself.
Yeah. In saying that though, Ed, if you've been able to kind of manage your cash flow and being able to kind of repay at that level, this decrease in the cash rate simply means that if you kept the repayment where it's at, you're now paying more of the principal than you are of the interest.
Yeah, correct. So it's not like you're locked. Like if you keep the higher repayments going, most of the case, if you've got a redraw account to your loan, that extra money would just be building up in the redraw account of your loan. It's not like you're just giving it to the bank and foregoing that money. It should usually stay like available funds on your mortgage or something like that. And it's essentially just chipping away extra principal away on your loan to help you pay the loan off faster.
Yeah. And I think what my biggest concern about interest rate cutting, especially at the moment, is that I'm just hoping that people have the, how can I say this, the discipline to go away and use that money for good. I would not like to see, which unfortunately I think I'm going to see, is that interest rates cut, people drop their repayments to the minimum, and then all of a sudden they're using that surplus cash flow on lifestyle again, which is kind of, I've spoken about it many times, about increasing lifestyle costs through debt, which is, a debt-fueled lifestyle. So, Anthony, what are you saying to clients that, obviously since the announcement, what are you saying to your clients?
Well, it depends. It varies client to client. Each client's circumstance is going to be a little bit different. But if a client's already got a healthy buffer in their bank account and their cash flow is good, I would like to see them try to continue to keep these repayments as they are for now. Realistically, the difference in the new repayments with current repayments isn't going to be huge. Let's say it's about $100 a month for most people around that mark, depending on mortgage sizes. So it's not like we're going to have thousands of dollars a month surplus. It's going to be, let's say, $100 a month. So it's probably not going to make a huge difference for now, but as the future rate cuts come through down the track, it adds up, and there might be, let's say, $200-$300 a month extra in surplus cash flow. That could start to make a little bit of a difference to a lot of people. So what I'm sticking to for now is, if cash flow is good, there's money in savings, and just continue as is. But if it's people that have change in circumstances coming up, they're expecting their first child or their second child, whatever it may be, and we need to build up the bank accounts, then yeah, let's allocate that to savings, build that up a little bit, help chip away with building savings up a little bit more for now, and then reassess the circumstance as things change.
And what are you seeing overall? Like, obviously we see majority of the people that we see are not struggling. Let's be honest. They've got good cash flows. They're moving forward. They're, got a system. They're either on their journey to financial freedom or are. But maybe even in your circles that how are people finding it at the moment out there?
It's very tough. Like, if you go back a couple of years ago to what the situation was then to what it is now, it's very different. Like, some people's mortgage repayments have close to doubled. And when you've got that taken into consideration, like,
plus with their lifestyles doubled.
Yeah, plus with I hear all the time, groceries bills going up an extra $100 a week for most people over the last couple of years. So when you get all that taken into consideration, a lot of people are struggling and doing it hard. So this is a breath of fresh air, even though it is only $100 a month. Like, $100 a month for some people is a lot, depending on their circumstance. So it's a breath of fresh air for a lot of people, because it is pretty hard out there for a lot of people doing it tough.
Yeah. And what's interesting is around what you said around people's obviously lifestyles and the cost of groceries and this and that. And this is my biggest concern with dropping interest rates. And I'm really glad that the governor kind of a part of hey, we're dropping the cash rate, but they don't get ahead of yourself to think that we're going to go into like a rate cutting cycle. Because the worst thing we can do is have inflation continue to stick around. So you've got inflation and you've got inflation expectation. Inflation expectation is, say me as a business owner, I expect inflation to be around at, say, 4%. So I'm constantly increasing my services by 4% because I'm thinking that the expenses that I need to pay is going to increase at 4%. Therefore, there's this kind of perpetual motion of increasing costs. And so that's inflation expectation. Obviously, inflation, in regards to how it's measured, is obviously how much have they rose. So it's like a backward-looking data. So for me, I think that people are going to be paying more overall because of the relief that they've been given from an interest rate cut. So some people don't want to hear that, but that's the reality. And if you look at like if you want to see about like this disparity between the rich and the poor, it always increases when inflation environments happen. So the RBA and both the government from a fiscal policies perspective really need to get inflation under control and stay under control. We do not want to see, and just, I don't want to put doom and gloom on this, but Anth, imagine we just had a situation where inflation starts ticking up again. You know, just think about that. Yeah, and if inflation starts ticking up again, what, do we go on another rate hike cycle? You know, you just told me about people struggling. So, you know, as much as you want relief, think about the consequence of inflation going back up. And if inflation does go back up, that means that cash rate's going back up. And it's harder to get it down the second time.
Yeah, for sure.
So I wouldn't want to be the governor of the RBA. It's a tough job. It's a seriously a tough job. I would like to see better support in regards to the government. I am concerned of going into a federal election, what that means, because usually they want to kind of butter up the population to get some votes. So, but it's not a time to do that. It's not a time to butter up things. It's really a time to get the economy humming, so that we have what we've always had in Australia: great prosperity, great standard of living, great equalisation of income. And I think what the other thing is, I'd like to say, is decreased wastage and money spent on really fundamental things for Australia that is going to push us moving forward. You know, talking about interest rates, you know, does that mean that we now have some stimulus in regards to the building and construction industry? And I'm not talking about just, you know, city buildings and stuff like this. I'm talking about increasing supply of housing. We do have a demand shortage. Cost of housing is obviously increasing substantially. It's probably not going to happen by 0.25% decrease, but we need to get that supply back up and running. We need to get something happening, because where interest rates are going, where prices of houses are going is concerning. We have a rental issue as well too. So I feel like there's a lot of headway. I think there is solutions to it, but I wonder if there's the people to make the decisions. So going back one step in regards to another cohort that we need to be mindful of, and for everyone, because they are in this cohort as well too, is the investors. So what I mean by that is that, yes, we've talked about lenders coming in, applying the full rate cut, which in some cases they don't go full rate cut. Sometimes they'll 75% or 80% of the rate cut. They don't need to give the full rate cut. But obviously what that means for savings accounts, you know, what that means for the fixed interest bond market, or the bonds or the debt market, and what it means to equities and property as well too. So, you know, the most clear one is around that savings rates, which have been quite good, are going to start to drop. And if you look at especially the self-funded or self-funded retirees, they're now going to get less money from their safety bucket, which for a long, long time, and everyone, the self-funded retirees had to move money to more riskier assets to generate the incomes to support their lifestyles. And so when interest rates go down, usually, okay, we start to see, not straight away, but very soon after, we start to see increases in both the property market and increases in the equity market. So cash rates come down, yields on bonds come down, and we start to see this cheaper money return, and therefore equities continue to go up. So you've got a market where you've got an inflationary issue, interest rates go up, the wealthy can push through that because they've got good cash flow. Then when interest rates go down, the wealthy who own the assets, the properties and the stocks, end up winning the game because they come out from a cheap debt market and asset prices continue to flourish. It sounds pretty sad, Anth, you know, that you can see how the wealthy kind of always win. But for you watching or listening, you need to start thinking this way. You need to start thinking about, how can I build a system? How can I think of my money to structure it in a way like the wealthy do? And a thriving wealth, you know, half of what we do is around structuring their money to benefit from the system. It's not to break the system, it's to benefit from it. So investors need to be mindful that this cash rate lever does have an impact on asset classes. And yes, it has a big impact on mortgage holders, but it also has a huge impact on things like your superannuation, your investment accounts, your long-term wealth strategies. So obviously we think very long-term. We think very strategically. But are you seeing any maybe signs of investment questions or issues that maybe people are having?
I think that the issue in the past was just trying to find the cash flow for things like investments. When mortgage repayments kept going up, people needed to take money from somewhere, and most often it was okay. We're going to have to reduce. They wanted to reduce how much they were investing to cover for the mortgage, because people don't often like sacrificing on lifestyle, so they sacrifice from their future instead. And it's a hard conversation that we need to have sometimes, where okay, we really need this money for you to get to the position where you want to be. Let's leave that and see where else we need to sacrifice. So there was a lot of that conversation.
Are you having conversations, Anth, around like, should I invest more or should I put more money into my mortgage? Like when I think about interest rate cut, like that's a common question.
Yeah, so that's always a one. And like a lot of people are really fixated in just paying off their debt as soon as possible and not really considering the other options. So having a look, okay, like it's really got to think about it on a bigger scale, like diversifying where your money goes, superannuation, investments, savings, debt, and just trying to find the right balance. But yeah, like a lot of people do want to try put extra into their mortgage, but then might not be thinking about what else they could be doing with that money instead and what those returns could potentially be.
And I think the biggest thing is around just thinking about, like, if you're making decisions based on a short-term scenario, you're usually always going to lose.
Yeah.
Because you're not seeing what the impact of your decision is in 20, 30 years. And I was having a conversation with a client last night, late at night, to be honest with you, and he won a massive contract that he's been working on for the last 20 months. And just to put it in perspective, his portion of what he'll make out of that will be a $400,000 payout in one go. Huge money, guys. But we were talking about, like, not just if he puts that in his offset account, what the kind of impact that's going to be in regards to his cash flow, but like the interest rate saving, I think worked out to like $328,000 over the next 10 years in regards to the savings cost. And the first thing he said, because he sends his kids to private school, is there's the private school paid for. But interestingly, I said to him was, yes, that's okay as an initial discussion, but we need to map out what the difference that's going to make in regards to your investment structure, because he still wants to retire early. He still wants to do all of these things. So yes, it sounds really good and it's a solid one because you're going to get a guaranteed return from paying off your debt. However, what's the opportunity cost? So I think that what is the scenario between does my extra cash flow go towards the debt, especially when I've now got a small amount of extra cash flow from this interest rate cut, or do I put more money towards investments, is ultimately based on what's the end goal and then reverse engineering that. And I think the other thing as well too is that these interest rate cuts or interest or home loan repayments are also in after-tax dollars. So what I mean by that is, like, let's say, for example, you don't need, or let's say you're going to have $100 a month less that you need to pay on your mortgage. Well, you might be able to do $150 a month into your salary sacrifice, be in the same cash flow scenario, salary sacrifice into super, still be in the kind of same cash flow scenario, but all of a sudden you're putting $150 a month into your superannuation so that you've got more of a tax-free asset. So I think a lot of people that I see don't think about it that way. They think about, I've got the extra cash flow. Well, I want to buy some ETFs. I want to buy some crypto. I want to buy some whatever, or I want to buy some more things for myself. But what are you sacrificing for later on? And it actually reminds me of of something that I read today was around, being financially free and staying there is not easy. It's hard, yeah. But if you want to have your life easy and comfortable now, you're just making your tomorrow that much harder. So the harder you work today, the easier you make your tomorrow. And so when I think about these interest rate cuts, for mortgage holders, think wisely. Don't blow the money. Yeah, use it for good. For investors, this does has an impact. Okay, interest rates is one of the biggest powerful lever around your investments. I haven't even talked today around like the impact on the Australian dollar and obviously what that means from an international perspective and the impacts there, but that also does. So having a robust plan that is not just a static plan, but is constantly updated and there's strategicness and also a non-emotional way of managing your money is the way that's going to create the highest probability of you achieving your goals and aspirations. There's a lot of things you can control. There's a lot of things you can't control. You can't control what the governor does. And you can't control what the stock market does. But you can control what you do with your cash flow. You can control how much you pay the tax man, how much you pay in fees and interest. You can control those things by the way that you structure your assets. Now, obviously, control to a certain level, okay? But hopefully this has been really informative. I'd really like to deep dive into this. I've seen a lot of commentary in regards to the announcement, but I really wanted to dive in today with you, Anthony, around what we do and how that can obviously help someone. So thanks for jumping on. Thanks for watching. Thanks for listening. And remember to like and subscribe on all of our major platforms and on YouTube and on Spotify and Apple Play and whatnot. But also as well too, if you're loving these, share these with your friends and your family because I know a lot of people out there would love to learn about what they can do with obviously today's topic. But there's been over 50 odd episodes where we're talking about different topics that are helping people improve their financial literacy, which is one of my missions before I leave this earth, to educate as many people in Australia. So that's a favor from me, but thank you for watching and listening. Cheers.
Thanks, guys.